Enron Corporation was once a giant in the energy sector, celebrated for its rapid growth and innovative business practices. However, its spectacular downfall in 2001 marked one of the most infamous corporate scandals in history. Enron's collapse revealed a web of financial deceits, accounting fraud and ethical lapses that shook the business world and led to widespread consequences. Enron, founded in 1985, transformed from a traditional energy company into a diversified corporation involved in energy trading and various other ventures. The company's success was built in complex financial structures and accounting loopholes that allowed it to conceal debt and inflate profits. Key players in Enron's leadership, including CEO Jeffrey Skilling and Chairman Kenneth Lay, orchestrated these financial manipulations to present a facade of robust financial health. The unraveling of Enron began in 2001 when investigations exposed the company's deceptive practices. The discovery of off-balance sheet partnerships, such as the infamous Special Purpose Entities (SPEs), revealed massive debt kept hidden from shareholders and regulators. Enron's stock price, once soaring, plummeted, causing substantial financial losses for investors and employees who had invested their savings in company stock. The responsibility for Enron's collapse extends beyond its top executives. Arthur Andersen, Enron's accounting firm, faced scrutiny for its role in approving misleading financial statements and shredding documents to obstruct investigations. The failure of regulatory bodies and credit rating agencies to detect and address fraudulent practices also contributed to the crisis. In 2001, Enron filed for bankruptcy, marking one of the largest bankruptcies in U.S. history at that time. Thousands of employees lost their jobs, and investors suffered substantial financial losses. The Enron scandal prompted sweeping regulatory changes, including the Sarbanes-Oxley Act, aimed at enhancing corporate governance, transparency, and accountability. Moreover, the Enron scandal unfolded as a revelation of internal financial fabrication and misleading representations of the company's success. While Enron experienced operational achievements throughout the 1990s, its deceptive practices were exposed in 2001. Leading up to the new millennium, Enron's outward appearance conveyed prosperity. By 1992, it had become the largest natural gas provider in North America, introducing Enron Online, a trading website for enhanced contract management, just months before the year 2000. The company's global expansion was evident, marked by the 1998 merger with Wessex Water. During the 1990s, Enron's stock price generally mirrored the S&P 500, but heightened expectations caused a surge. In 1999, the stock increased by 56%, followed by an 87% increase in 2000, far surpassing market returns and resulting in a 70-time price-earnings ratio. In February 2001, Kenneth Lay stepped down as CEO, succeeded by Jeffrey Skilling, who, in turn, resigned in August 2001, with Lay reassuming the role. Enron Broadband reported significant losses around this time, with a 2001 financial loss of $102 million. Concerns over Enron's accounting practices emerged, notably from Sharon Watkins, a vice president who anonymously wrote a letter to Lay expressing apprehensions. Despite her efforts, investigations by an external law firm and Enron's accounting firm found no issues. By October 2001, Enron reported a third-quarter loss of $618 million, prompting the need to restate financial statements from 1997 to 2000 to address accounting violations. The unraveling scandal exposed a complex web of financial deceit and marked a significant corporate collapse. In the unfolding saga of Enron's demise, the pivotal moment came on November 28, 2001, when credit rating agencies downgraded Enron's credit rating to junk status, sealing the company's fate in the abyss of bankruptcy. Simultaneously, Dynegy, the energy company Enron sought to merge with, abruptly terminated all talks and abandoned any merger agreement, causing Enron's stock price to plummet to a mere $0.61 by day's end. The cascading effect commenced with Enron Europe filing for bankruptcy on November 30th, followed by the entire Enron entity on December 2nd. In the aftermath, Enron severed ties with Arthur Andersen, its auditor, accusing them of advising the destruction of evidence and documents. In 2006, the remnants of Enron culminated with the sale of its final business, Prisma Energy. the subsequent year witnessed a symbolic transformation as the company rebranded itself as Enron Creditors Recovery Corporation, signaling its commitment to settling outstanding debts and liabilities as part of the bankruptcy resolution. Post-bankruptcy, the new board of directors, determined to hold accountable those complicit in concealing Enron's fraudulent practices, filed lawsuits against 11 financial institutions. Enron secured approximately $7.2 billion through legal settlements from institutions such as the Royal Bank of Scotland, Deutsche Bank, and Citigroup. Legal repercussions unfolded for key figures, with Kenneth Lay facing 11 criminal charges and pleading not guilty. Although convicted on 6 counts of securities and wire fraud, Lay's demise preceded sentencing on July 5, 2006. Jeff Skilling, found guilty on 19 of 28 securities fraud charges and additional insider trading charges, received a 24-year, 4-month prison sentence. However, a 2013 deal with the U.S. Department of Justice reduced Skilling's sentence by 10 years. Andy Fasto and his wife Lee pleaded guilty to various charges, including money laundering, insider trading, fraud, and conspiracy. Fasto, serving a 10-year prison sentence with no parole, collaborated to testify against other Enron executives, subsequently gaining his release. The post-bankruptcy era marked a complex interplay of legal proceedings, financial settlements, and the intertwining fates of Enron's key players. Furthermore, looking forward to the causes behind the Enron scandal reveals a multifaceted narrative encompassing the following factors. In the intricate tapestry of deception leading to the Enron scandal, the company orchestrated an elaborate scheme to bolster its financial statements, camouflage fraudulent activities, and present convoluted organizational structures, all to bewilder investors and obscure the truth. Special purpose vehicles. Enron strategically employed special purpose vehicles, SPVs, or entities, a legitimate financial strategy when used appropriately to obscure the true extent of its debt. However, Enron's lack of transparency in utilizing SPVs became a major issue. The company engaged in intricate transactions, transferring its own stock to SPVs in exchange for cash or notes receivable. The SPVs, in turn, used the stock to hedge assets against Enron's balance sheet. When the company's stock depreciated, the collateral held by the SPV lost value, exposing the vulnerability of this financial maneuver. Inaccurate financial reporting practices. Enron engaged in inaccurate reporting of contracts and customer relationships, collaborating with external entities, including its auditing firm, to record transactions incorrectly. These inaccuracies not only deviated from generally accepted accounting principles (GAAP), but also violated contractual agreements. Notably, one-time sales were deceitfully recorded as recurring revenue, and expired deals were intentionally prolonged to avoid write-offs. Poorly constructed compensation agreements. Enron's financial incentive agreements with employees were flawed, emphasizing short-term gains and deal quantities without considering long-term viability. Compensation tied to stock prices created a rapid rise in equity success, fostering a pursuit of equity positions within the company. Lack of independent oversight. External entities aware of Enron's fraudulent practices often refrained from intervention due to their financial entanglement with the company. Arthur Andersen, Enron's accounting firm, received lucrative compensation for its services, while investment bankers and buy-side analysts benefited from financial deals and promotions respectively. Unrealistic market expectations. Enron Energy Services and Enron Broadband overestimated their success, promising services and timelines that proved unrealistic, driven by over-optimism and inaccurate assessment of market trends. Poor corporate governance. The ultimate downfall of Enron stemmed from inadequate corporate leadership and governance. Despite concerns raised by Vice President of Corporate Development Sharon Watkins, top management and executives deliberately ignored and dismissed these warnings, setting a precedent that permeated various facets of the company, from accounting and finance to sales and operations. As the layers of deception are peeled back, the Enron scandal unveils a complex narrative of corporate machinations, financial missteps, and a failure of oversight that culminated in one of the most infamous collapses in corporate history. The demise of Enron serves as a cautionary tale about the dangers of unchecked corporate power, inadequate oversight, and the ethical implications of prioritizing short-term financial gains over long-term sustainability. It stands as a landmark case that shaped discussions on corporate governance, financial reporting, and the ethical responsibilities of corporations and their leaders. Understanding the Enron saga allows us to reflect on the consequences of unchecked corporate greed and the imperative need for transparency and accountability. If you found this exploration into the Enron scandal enlightening, don't forget to like this video, share it with those intrigued by corporate scandals, and subscribe. Stay tuned for more.